Okay, so dividends, corporations can pay cash or property, and these are called distributions. They're usually called dividends. So the dividend would be, and it's taxable to the recipients. The corporation cannot deduct the cost of the dividend, and the shareholder reports taxable income in the amount that is equal to the fair market value of the property received. Usually these dividends are in cash, so that's really easy to determine what the fair market value is. To the extent that those distributions are from the earnings and profits of the corporation, it's called a dividend. So that means that it's been generated, the income or the money, the funds to fund the dividend have been generated through operations. It's not they borrowed money to pay a dividend, or they sold more stock to get cash in to pay out dividends, which companies do. You want to look out for that because it means they don't have enough, they're not generating enough cash to pay out these dividends. But if it's from the earnings and profits, which like it says is conceptually similar to retained earnings. So they've earned the funds. If it's from that, then you get the benefit of that lowered tax rate for a qualified dividend. If it's not from the earnings and profits, what it does to the owner of the stock is any distribution is essentially a return of capital. So if they paid $1,000 for their stock and the company pays them $500 in a distribution and it's not from earnings and profits, it's essentially seen as $500 of that original $1,000 coming back. Okay. In that case, it would not be taxable because it's just a return of capital. But if the payment is more than what the basis is, then the amount over and above would be a capital gain. So if you paid $1,000 for stock and the company, not through earnings and profits, pays you $1,200, then $1,000 is your return of investment. So now your basis is zero. $200 over and above that is capital gain. So you would have a capital gain. It wouldn't be considered a dividend. If the corporation makes a distribution of property, not cash, if it has a basis less than the fair market value, so if it's appreciated property, the corporation is treated as though they sold the property at its fair market value. The corporation would then recognize a gain on the distribution of that. So if they distribute a building that has a basis of $100,000, but it has a fair market value of $200,000, it's as though they sold it. They're going to have to recognize a gain of $200,000, but then the basis to the recipient is going to be $200,000. So here they've got, that's too simple. Sasha receives a $500 cash distribution from the earnings and profits of Alpha Company. The dividend is fully taxable to Sasha as a dividend. Assume Sasha's distribution was in the form of a property with a fair market value of $500 and a basis to Alpha Company of $400. Alpha is going to record a $100 gain. Sasha's going to report dividend income of $500, and their basis in that property is going to be the $500. We've got Quad Company, E&P of $5,000. It makes a $6,000 cash distribution to Quincy, its sole shareholder. Assuming Quincy has a basis in his stock of at least $1,000, he's going to report dividend income of $5,000, a non-taxable return of capital distribution of $1,000. He's going to reduce his basis in the stock by that $1,000. Let's say that the basis in Quincy's stock is $200. He's going to report a dividend of $5,000, a non-taxable return of capital of $200, and a capital gain of $800 in this scenario. And his basis in the stock is then going to be reduced down to zero. So corporations can make a non-pro rata distribution by which one or more stockholders receive a distribution that is not in proportion to their ownership percentage. So they can pick and choose different shareholders to give preferential treatment to. If If the distribution is an appreciated property, the corporation has a deemed sale and a gain based on fair market value. The shareholder reports dividend income equal to the fair market value of the cash or the property received. The shareholder can also receive a distribution in full liquidation of their ownership interest. So they're selling their stock essentially back to the company. A shareholder may sell all of their stock back to the corporation for cash or property. The shareholder will have a capital gain or loss equal to the difference between the fair market value of the distribution and their basis in the stock. So just like if they sold their stock to a third party or anybody else, if they sell it back to the company and essentially make it into treasury stock for the company, then the gain is treated, the gain or loss is treated the same. Corporate liquidation, this is when a corporation goes out of business. Corporation will pay debts and distribute any remaining assets to shareholders. If it's a complete liquidation, the corporation will record all assets and liabilities at their fair market value. Shareholder will report a capital gain or loss equal to the difference between their basis in the stock and the fair market value of the property received. So just as if they got some other type of payout for their stock, it really wouldn't change the manner in which it's reported. Example, Tara received cash of $5,000 and other assets with a fair market value of $7,000 as a result of the complete liquidation of Blue Corporation. Her basis in the stock was $10,000, so she received $12,000 out of it, right? She's going to report a return of capital of $10,000. It's not taxable to her. She's just getting her money back out of it, and a capital gain of $2,000. So that's the amount over and above the amount that she had invested.